Hello to all the debt warriors listening, and welcome back to another episode of Millennial Debt Domination. I'm your host, Katie Fada. Last year, we did an episode with Winnie's son about investing for beginners. That seemed to be a topic that many of you were interested in, so today's episode is going to elevate that topic a bit. Today, we'll be talking about a sector of investing, the stock market, and how to break into the stock market. Many millennials and Gen Z-ers haven't tried their hand at the stock market yet because they might not be sure how to start. After today's episode, I think that many young people will feel comfortable getting started with stock investing. On this episode, I'll be joined by Chris Larkin. Chris is the managing director of the Digital Brokerage Product at E-Trade by Morgan Stanley. Chris knows a ton about stocks and how to get started with buying them and eventually selling them. Chris and I will be discussing what the stock market is, how you can make money from the stock market, when the right time to sell a stock is, and much more. Now, let's get to my interview with Chris. Hi, Chris. Thanks for being on the podcast today.
Thanks for having me. I appreciate it.
Yep. So today we're going to be talking about breaking into the stock market. And I know you kind of have a lot of knowledge of that, so I thought you'd be a great guest. So I guess to start, in a nutshell, what is the stock market and how does it work?
Well, I mean, the stock market, it's a pretty general term, but I think the best way to describe it is really that it's a very secure and highly regulated environment where, basically individuals and institutions can buy and sell securities. And if you go way back, when the first stock exchange, because some people kind of interchange the word stock market and stock exchange. The first stock exchange is the New York Stock Exchange, which was formed back in the late 1700s. But obviously over time, things have changed in a big way. So there's been a lot more competition. So New York Stock Exchange is not the only game in town now. We're now filled with a whole bunch of execution venues that's created a really good environment for all participants to get a much better execution on any of the securities that they're trying to buy.
So you mentioned the stock exchange. So who governs that?
Well, there's a place called the Securities and Exchange Commission, and they're the main regulator that sits over the exchanges. This was the exchange. The Securities Exchange Commission was created back in around 1934, and it really was after the crash of 1929. So if you look at that period of time when the New York Stock Exchange was formed in the late 1700s and all the way up until the crash of 1929. It was a self-regulated exchange, and so they felt like there was some government oversight that needed to happen. So they formed this entity, and the main regulator that sits underneath the Securities and Exchange Commission is called FINRA, and they are basically the ones that enforce all of the rules that the SEC puts in place.
So I guess if someone's looking to get started with stocks, how do stocks become available in the first place? And then why do companies allow people to purchase a share in their company?
Yeah, so there's several ways that companies raise money to operate and grow their business. I think so. Issuing stock is one way. There's ways that you can issue bonds, but let's stick with the stock market right now. And basically, it's just a security that gives the investor a fractional ownership of the company. They raise money and they use this money to reinvest in their company and then also operate. But I don't want people to get mixed up with the idea of ownership and day-to-day operations. Like the day-to-day operations is up to the company. They're gonna handle the strategic view of what they're trying to do, and they're gonna execute. So an individual investor is not gonna have any impact if they're able to do one thing or another within the company. You're just investing and having an ownership there. But it does give you voting rights. It gives you voting rights, against things like, the board and executive compensation and some other things that are out there. But you're going to participate in the success or potentially the failure of a particular company when you buy stock.
So kind of no matter how small the stock is, you still have those same rights as people who own more.
Yeah, in general, there are some small, sort of edge cases where there are issuance of stocks where you do not get any type of voting rights. But I would say, in general, almost every company, when you own a stock, that you will get voting rights with that particular company.
Oh, okay, good. So I feel like if people don't really know anything about stocks, they still have heard of the Dow. So can you explain the Dow and why it's relevant?
Yeah, and so the Dow is the Dow Industrial Average. It is obviously been an index that's widely viewed on a daily basis. And it really basically it was created a long time ago, and it really represents what's the overall direction of stock prices in a given day, month, year. So people would look at it, in the past and today, but it's only 30 stocks. Back in the day when there's not as many companies that were listed on a stock exchange, it was a great representation, and it continues to be a great representation today. They swap out these companies over the years to make sure it does represent the overall market. If you look way back when, it was, it's called the industrial average. It was filled with just industrial stocks. But over time, that's now been diversified to kind of, get a better sort of broad indication of what's happening. One of the more widely, watched indexes is called the S&P 500. So same concept. People look at that, I think, more today as the broad representation of how the market is doing. S&P 500. There's 500 companies that are in there, so it's a much more diverse base of companies that's in there. So I would say today that's probably more widely looked at Dow, but I would say it's on equal footing. You can't go to a TV screen that's talking about financial services or looking at the local news in the morning when they're not going to refer to both of these indexes that are out there.
Right. So I think a lot of people decide they want to invest in the stock market because they want to make money. So how can an individual make money from the stock market?
I would say, basically there's really two ways. If you kind of break it down in general, there's really two ways. One is through share price appreciation. You buy a stock, you want to go out and buy 100 shares of stock, you buy it at $20. The idea is that you're going to invest in this company, you're going to do all your homework, from a fundamental perspective, and depending what type of investor that you are, maybe some technical indicators that you're looking at. And you're going to expect to go higher. So you buy it at 20 and you're hoping over a period of time that you would sell it for a price higher than 20, depending upon sort of where you think that company is going to go. And then there's dividends that some companies pay. Not every company pays dividends. But once again, that's another way that someone can actually participate in making money in the stock market.
Can you just elaborate more on dividends too?
Yeah, I mean, so dividends, they're basically a distribution of the company earnings, and they're generally paid in cash. Sometimes there are stock dividends that are out there, but again, I think they're relatively edge cases of how that actually happens. But it's just a part of the company earnings that people put out there. There's a lot of reasons that they do that. It's they do want to share some of the profits in the particular company, but it also makes it a much more desirable company to purchase from an institutional perspective. So if you think about the ideas around mutual funds and things like that, people do like companies that pay out dividends.
Right.
So
do you have to pay taxes on money you earn from stocks?
I think the government always finds a way from a tax perspective to take a little piece. So yeah, for dividends, absolutely. So you do have to pay taxes on the ones that you receive, depending upon, again, what tax bracket that you sit under. But in general, almost all dividends that you're going to receive, you're going to have to pay some type of tax on it.
Okay. So we kind of talked, you touched on mutual funds a little bit earlier. So what would be the difference between investing in a mutual fund as opposed to investing in an individual stock?
Yeah, so if you go back, so mutual funds, there's really, I'll kind of use two things, in that question, because there's really two categories if you think about the actual topic. So one you have is a mutual fund, and a mutual fund is basically, there are many types of mutual funds. Some are based upon, let's call them what they call passive funds that are out there, and that's basically investing in an index. So you can buy things like a Dow, a product that represents and tracks exactly the performance of the Dow. You could do it for the S&P 500. You could do it for basically any index that is out there. You can buy a mutual fund and get exposure to that particular index and share in the gains or suffer the losses of the performance of that particular index. There's also a product called an ETF. That's an exchange traded fund. And there are a little bit of differences between the two, but if you take the idea of a mutual fund and the ETF, it's basically the same thing. It's just you're getting access to a a diverse group of stocks representing something that's out there. And there are a lot of different products that are out there. One is passive, and then you think about the active part of it, where it's featured, where you have like a fund manager that's picking a whole bunch of stocks that they feel is undervalued, and that it's gonna outperform some of these indexes that are out there. And the big difference, I think, for the ETF and versus a mutual fund is that in a mutual fund, they only price that particular security once a day. So if you want to go out and buy a mutual fund today, you put your order, say I want to buy $10,000 worth of this mutual fund. At the end of the day, you'll get your execution. If you want to sell it, once again, you'll get an execution at the end of the day. There is no intraday trading. Within an ETF, there's a big difference there. You buy and sell it just like a stock. So you go into the stock market, and if you want to buy it today at 10:30 and sell it at 11:30 in the morning, you can do that. So it's a liquid product that goes throughout the day. And so the good thing about them is there's basically any kind of way that you want to invest, whether it's ESG or it's you want to go invest in something from an active standpoint, any kind of index. You will be able to find a mutual fund out there. But again, it's a low cost. You get to diverse, as opposed to being sort of, if you don't have a lot of money and you want to go out and invest, this is a way to get a better representation if you have just a little bit of money to invest, as opposed to putting all your money or your eggs in one basket.
Yeah, because that kind of like led into my next question again, like how would you recommend young adults get started in the stock market, particularly with a low budget? Would that be how you recommend maybe millennial to get started if they've never done it before in anything with the stock market?
Yeah, I mean, I've been at E-Trade for a very long time. We have catered to young investors, and if you look at sort of how we've been growing today, by far, the number one account that opens up today is a young investor, and specifically in that sort of millennial category. And it does come down to that idea. Like, it depends how much money you have. If you think about the idea of how much money you have and what kind of risk that you want to take and things like that, what's your time horizon. We always recommend that people start out by buying a diversified product. So something like an ETF, which is extremely low cost. You can come to a firm like ourselves and do that commission free. And from a mutual fund perspective, depending upon what type of mutual fund that you want to buy, many of them come with zero commissions, but there are some that come with fees. And so, but there's a broad choice. I think we offer over 10,000 separate types of mutual funds, and then we will offer every single ETF that's available for clients to buy and sell on a particular exchange. Mm-hmm. So the choices that young investors have is incredible. But I understand that there's some younger investors that enjoy or have a passion about a particular company, and so there's the ability to go buy. You can buy as little as one share of a company if you want to, and again, at a world where you're commission free, it's never really been better for them to get access to individual companies as well.
Right. So, when would you recommend someone start maybe investing? Would you recommend when they have a lower budget, or wait till they can invest more, or it doesn't matter?
I always recommend starting early. I think that's, I think the main problem for most people, and I think the mistakes that people make, is they wait too long to invest their money. So, there's a few ways that you can do that as an individual. At a minimum, if people are starting out in their careers, I think almost every company offers something like a 401k. That is basically a retirement savings account where you can put a portion of your paycheck into there, and that will grow over time. I started very early myself when it came down to that, and it's amazing if you start early and over time, you are consistent in making those contributions to a product like that. It's a great way to get exposure to the market, but it's also just a great way. Your cost dollar averaging every month with your paycheck, and over time that is likely to grow over time as you do that. So I think it's important to start early. If you have the financial resources, and again, you don't have to put a lot in. I mean, it's really up to you, like how much you can afford. But again, the barriers have never been lower. Like there are no minimums to open up accounts for us. The 401ks are available to everybody. Costs have been coming down. And the reality is that you can't rely upon things like Social Security anymore to really be able to retire. So it's extremely important for people to start early and think about the long term, and it gives them the ability to kind of ride out some of those sort of volatile environments that we see every day. If the market goes down over time, those things start to smooth out, and it becomes less of an emotional trade for a client.
Right. I actually did a whole 2-part podcast about Social Security and benefits and everything. So I'll put that in the link of this podcast, or put that in the description of this podcast, so you all can listen to it there. So what's the difference between using a financial advisor and an online brokerage account?
Yeah, I think, fundamentally, I think it's really two things, and there's been some evolution that's happened over time. But broadly, there's if you take an online brokerage account, we call them sort of self-directed. It's like, in general, I would say most of the clients that come here today want to make their own decisions, and what we do is we give them the tools and the resources to help them make very sound, quality investment decisions. So if they have an idea, they have lots of tools that they can go out there. They're all free to the client. Whether you want to look at news, charts, research, you can look at a whole bunch of things that are in front of them, and then we'll give you a very high-end, experience, whether it be through a mobile platform or an active trading platform or the website, however way that you want to connect with us to make that transaction. You have that all available today. So that is in there, and I'll talk a little bit after about how that's evolved over time. So that's mostly what clients come to a firm like E-Trade or Schwab or TD Ameritrade. A financial advisor will give you advice. So that you say to yourself, hey, listen, I want to invest in the stock market, but I don't know what I'm doing. I need a whole bunch of help, and I need someone to kind of give me some advice on what I should be doing. And so in general, I think when you think about a financial advisor, it's generally for someone who's got a bit more money in their account. But the good news is, because there really was sort of a gap between an advisor and sort of who they can actually handle, because there's only so much a human being can handle in terms of client business and number of accounts that they can hold or service in a way that they need to be serviced. But from our side, we've been filling that gap really through some products and services that kind of fill that gap for people that need some guidance. So, you've probably heard the term, or people have heard the term, a robo-advisor. Mm-hmm. A robo-advisor is really basically, you go through a whole sort of a questionnaire. It's a relatively short questionnaire. It captures your, when do you need the money? What's your risk tolerance? Are typical questions that come through it. And at the end, it's going to drop through, like, basically, it'll show you 3 separate portfolios, and it's going to basically say, like, what are you comfortable with in terms of how much are you willing to lose in a given year, and from a gain perspective. And you're going to choose that one based upon your risk tolerance. And then, but you'll basically purchase the product, and then what it does over time is it rebalances it for you. Because over time, the market, there are some sectors that outperform and some that underperform. And what they do is they constantly will rebalance your portfolio, so you make sure that it's on track with with all the questions that you put together. And these are some of the things that financial advisors do. They go back and they rebalance your portfolios. And with technology today, these are these amazing products that are out there at a very low cost. So, just as an example, to invest in a robo product at a firm like ourselves, mm-hmm. it's a minimum of $500. So if you have $500, I can put together a portfolio for you, and we will rebalance that portfolio for you on an ongoing basis from extremely low fees. So these are some really cool things that we've come out in the marketplace. And the fee structure will be different. Financial advisors, because of the that's sort of the white glove service that they're going to give you, and some of the access to the things that you get out there, generally comes with a higher fee. But again, people can balance. The good thing is you have choice in terms of what you're comfortable with. So firms like us, we were just purchased by Morgan Stanley. We've got a very large financial advisor workforce. And so if you have a choice, we can set you up with someone on that side, or we can go for a low fee choice through the self-directed account.
Right. And I could put a direct link to that in the description of this podcast too. So anybody who wants it can get it there. So yeah, do you ever recommend a minimum investment someone needs to make?
No, I mean, we don't. I think when it comes down, like, if you think about sort of my true north about the idea, I just want people to get started. Like, I don't really care how people save, whether they're going to put money to a bank account or they get into the market. I want people to save. Like I said, the barriers have never been lower for people to invest in the products that we have out here today. Again, everything is $0 commissions pretty much throughout the industry is what you're going to find. And there's no minimums to open the account. There used to always be a minimum for a client to open up an account. So again, you could buy 1 share of stock. There's some other things out there. You hear about fractional share trading. So you could buy a fraction of a share that's out there. So if you have a big company like Berkshire Hathaway, which is like, whatever, hundreds of thousands of dollars to buy 1 share, you could buy $5 at some places that are out there today. So really, based upon all the competition and choices that are out there, there's really no minimum for people to get started right now.
Is there like an average about how much it costs to buy a stock, or it's clearly different between companies?
Yeah, I would say in general, there's obviously some differences, but depending upon where you go. But if you go to sort of the pure online brokers that are out there today, there's virtually nobody who doesn't offer $0 commissions.
Right.
So basically, you can trade commission free pretty much everywhere, and that's a relatively new thing. It's been around for a while. It's never succeeded in the past, but about a little bit over a year ago, about a year and a half ago. It's the whole industry sort of just moved to that level, and so that has kind of been the sort of the leg up in terms of the growth, and a big reason why we've been attracting a lot of younger investors, because we've reduced that relatively small amount of friction in clients to buy if they want to put a little bit in. We've now got and collected, there's been a lot of growth in that part of the sector based upon $0 commissions.
So is there any other fees involved in making a trade?
The answer is yes, but I think there's, they're very small. I mean, there's some there's some regulatory fees that are in there that you would almost never really notice when you sell a stock. And that's, for instance, like when you sell a stock in the market, they have what they call as an SEC fee. It is extremely small, but it's that is to fund the SEC, which is a government body that's self-funded by all these things in the marketplace. So those are relatively small, and then depending upon some of the products that you have out there, if you want to buy, there's these products called options out there. There are per contract fees to buy options, and then there's other typical fees that you might see in a brokerage account, that you would see it like at a bank. There are some small things like bounce check fees and things like that you might see. But the good thing is, if you look, even at a site like ours, if you just go to eTrade, something like eTrade.com. Up on top, it says pricing and fees. We're very transparent on every fee that might be out there. Okay. Most of those fees are just not ones that you would see on a regular basis. It's just they're, if you want to send a wire out, which is people aren't doing on a regular basis, there might be a $20 fee or something like that.
Right. But it's nothing to detract somebody from buying a stock. Nothing crazy.
No, it's pretty plain vanilla. It's very transparent. The good thing about our industry is we've kind of pushed transparency in a big way. Yeah. Where it's back when I started back in the early 90s in here, when there was no online trading or internet and things like that, we were trying to push the idea that there was a lack of transparency amongst brokerage firms, and over time there's been just an amazing evolution of not only providing sort of the tools and services that we have today to the end user at virtually low to no cost. So I think it's very important that all the things that we've done over time has kind of got us to the point where we'd be able to scale out our business and eliminate the fees that are out there.
Yeah, I feel like that's good that you guys are upfront with it, because normally it's like read the small font for the fees or something, but it's good people are going to be able to know.
We've avoided it. Like I said, we put it front. We're not ashamed. We're proud of what we've done over the years, and so it's like we like to put it front and center.
Yeah. So there's obviously hundreds and thousands of different kinds of stocks, but are there any kind of stocks that should be avoided? Like, are there any red flags that a person could see that they should maybe avoid that stock?
Well, I mean, I probably would. I guess I would rephrase the question. I think really the question I kind of start with almost anybody that's out there, whether it's a client that calls us or if I'm speaking as a friend or anybody else that's talking about the market. I think you have to start with how much risk are you comfortable with? Okay. I mean, that's the first question everybody needs to ask. Like, how much are you willing to lose on a particular trade? And there are stocks out there that are more solid fundamentally than others. But you have to do your homework too. So I would say that, I wouldn't really say that are the stocks to be avoided, but it's based upon sort of the homework you do. What type of company are you willing to invest in? How well do you know this particular company? How much risk are you willing to take? When you're investing in a particular security. So it's important that people don't just buy a name. If they go back and look at a particular company and because they use a particular product every day, it doesn't mean it's a good stock. Okay. And so you got to make sure that you do your homework and make sure that when you're going into this particular security, you have a general understanding of sort of how they make money. And where they're going. Are they a growing company and things like that? So it's important to do that homework that's out there. And again, all this is completely available. I'm not just going to talk about just my firm. I think any firm that's out there, pretty much every firm that's out there, you have a ton of tools at your fingertips to find out any type of information that you want on the stock.
Right. I think that's such an important note is definitely do your research, because I feel like a lot of people might just buy something because they like the brand, but maybe do your research first before you buy a stock.
Yes, I think that is the thing I tell everybody, that I do talk to people all the time to find out, and you go to them about a particular stock. There's a tool that exists on our thing that I won't mention the name, but it's a fundamental tool, and it basically takes a look at a company and shows you how they make money. So if you take an example of a company like Disney, people are like, oh, I want to go buy Disney because I was just at the theme park with my kids, and there's all these people there, and they make so much money. It's a great company. But then you go back and you take a look at this tool. It shows you how much money Disney makes from their theme parks versus something like ESPN, which people don't even know is owned by the company. So we have things like that and a better visualization. When I buy a company like that, am I buying the theme parks? Am I buying a media company? Like, what am I buying? They have movies. There's all these things that are constructed at Disney. It's not just that theme park. But I would say a lot of people go out and buy Disney because they're like, oh, the theme park is awesome, and you find out it's actually a relatively smaller portion of their earnings in a given time. So those are the kind of things that people would just get a general idea of what they're buying in the marketplace.
Right. So we talked a lot about buying stocks. So what about selling your stocks? When do you think is the right time to sell a stock?
Well, this is probably the most important question that you'll ask today, because it's one that people avoid asking themselves when they buy stock. It's amazing to me because people always know they want to go out and they buy a stock, but you ask them saying, well, when are you going to sell? And they don't have an answer. And that to me is a fundamental problem. This really comes down to the risk management for any client that's out there. If you want to go buy something, you got to know when you want to sell. So that means that how much are you willing to lose on the security? You need to ask yourself that question. At what point do you feel like when you invest in this company that you actually made a bad decision? And so you need to see, this is what I want to get out. So that's number one. Number two is that if it reaches the target, where do you think it's going to grow to? Do you think this is going to go from $20 to $24, $20 to $30? You need to determine where at what point do you feel like that stock is valued at the place that you want? And so people have to ask that question on every single trade they do. And I think the good thing about it, so just to give you an example of some of the great technology that people have, you could put like orders in, you could buy a stock and you can say, hey, listen, if my stock drops by 10%, I want to sell it because that was not right. And if it reaches up 20%, I'd like to sell as well because it kind of reached my place where I want to have it, and it will cancel the other order. Like, you don't have to look at your computer. It'll do it for you. So it takes the emotion out of trading. Establish your plan up front. Don't change your plan. And if you do change your plan, if you say to yourself, hey, by the way, let's say it's gone up 20%, and now you're saying, well, maybe it's going to go up 40%. You need to ask yourself again, exactly why do you believe it's going to go up higher? Is it just your emotions talking, or is there something that the company has done differently that you believe is going to take it to the next level? Maybe they introduced a new product. Who knows what it might be, but you have to ask these questions each and every day. Don't change your minds on emotion. Just do it based upon sort of very sound decisions.
Yeah, that's definitely important. Yeah, so I guess on that note, I think this is a great place to end the interview. I think you answered so many great questions about breaking into the stock market. So thank you again for taking time to talk to me today.
We're always happy to talk here. For us, the main thing from our side is we want everybody to be successful. Like, it's in our best interests to help all investors at every level. And the other thing is just the amount of education that's available is amazing. Again, I don't want to I'm not here to pitch my own company. But if you go to pretty much all the main online brokers, the amount of education that is available to teach new investors about the market, how to be successful, it's all free, and people should utilize those particular services that are out there. So if you go to pretty much anywhere where it says knowledge or education, go out and take a look at that before you invest, gain some confidence, and over time, like I said, you will be successful if you do all the right things, and that you're patient and that you do everything for the long term.
Yeah, that's some great advice. So I'll definitely link everything in the description of this podcast so everyone can do their research, and when they're ready to break into the stock market, they could go for it. So once again, thank you for being here today, Chris. I had a great time talking with you.
Thank you so much. I appreciate it.
I I think after today's interview, us millennials and Gen Zers feel more comfortable about diving into the stock market. Today's conversation about the stock market was a great follow-up to last year's podcast about investing for beginners. I'll link that episode in the description of this podcast so you can listen there if you haven't done so already. If you're considering buying stocks, do your homework and research first. As Chris said, you don't want to just buy a stock because you like a certain brand or company. You want to research about their stocks first before you make that investment. If you want to start investing in stocks but you don't have a lot of money, don't count yourself out. You can start by investing a small amount and work your way up over time. This is similar to investing in your retirement savings. Start with a small bit, and when you have more money, invest more. With that being said, that wraps up another episode of Millennial Debt Domination. Don't forget to subscribe to the podcast wherever you're listening, and if you're listening on Apple Podcasts, please rate and review us there. I'll talk to you next time, millennials, Gen Zers, and everyone else listening. Bye.